All right. Hello, everyone, and thank you all for joining us during the Lytham Partners Fall 2022 Investor Conference. My name is Robert Bloom, Managing Partner of Lytham Partners, and during this fireside chat, we welcome Vox Royalty, ticker symbol of VOX on the TSX Venture and VOXCF on the OTCQX, and their CEO, Kyle Floyd. We'll dive into questions here in just a moment, but I want to remind everyone that Kyle is available for one-on-one meetings later this week and throughout the week here. If you've not already signed up, please send me an email to bloom, B-L-U-M, at lythampartners.com, or you can visit the website, lythampartners.com/virtual. Click on the one-on-one meeting request button, and we can look to get you taken care of there. So, Kyle, welcome.
Thanks, Robert. Good to be back with Lytham.
Great. So let's start off kind of big picture, a little bit of overview on the company, your background, and then let's dive into the industry as a whole.
Yeah, so for those who don't know, Vox Royalty Corp was founded and created to be an outlet for investors seeking the right kind of commodity exposure. So my background was previously financing mining companies. I went back to Colorado School of Mines, and then really wanted to give investors an outlet for and solve a problem that I thought really was pretty profound in the markets, which was there are a lot of investors that want commodity exposure. However, they're not mining engineers, they're not geologists, they haven't been investing in the sector for 3 cycles. And so I saw a lot of, frankly, difficult investments that were made that could have been angled or could have put into the right type of company. And so that's what Vox was created to be. Within that, what I found, and if you look empirically at what is the best performing asset class in the entire commodity sector, it's royalties. So built a company around being able to find and acquire royalties, bring those into a portfolio, and ultimately deliver the right kind of risk and the right kind of returns for investors. That's what Vox is in a nutshell, and that's why it was created.
So talk about a little bit of the history of the mining industry, the mining royalty industry, how things have evolved here, and sort of how that dovetails into Vox.
Well, it's a really interesting discussion. There are so many investors these days that would like to get commodity exposure, and the biggest problem is, well, how to do that, because both the metals as physical price performance and also the basket of owning mining companies, both the performances of those different but similar asset classes have really underperformed the broader markets and broader indices. And so if you look at royalties, though, royalty companies, and then also more purely royalty assets themselves, empirically, those are the best performing assets within the commodity sector. So during this type of environment where you have rising inflationary pressures, and generally in inflationary times, commodities outperform, you'd say, hey, I want to get some of that commodity exposure. But when you look at the performance of the assets that you would typically be buying or led to buy, they haven't been very good. So they're not stacking up. Risk return is not there for what it should be. And so Vox, within this niche of royalties, we're finding terrific value. We take a percentage of revenue across mining assets all over the world. We're not an operator, which means we're not contributing any of the cost to run that operation. So once we buy a royalty, that royalty is ours, and usually it runs for the life of the mine, and we're entitled to the revenue that parcel of land or that tenement generates. And so that allows us to take, obviously, very good returns when metal prices are at these levels and higher, and we price in backwardation, so we actually price in lower metal prices, and we're able to grow a revenue-based business with very few employees, and very little exposure to inflationary pressures, which are afflicting all of us, whether we're investors or consumers. And so we have a very unique business model for this period of time.
So when you guys are looking at I guess, the royalty opportunities here, what is an ideal investment that you're looking at?
So what we're looking to do is we're looking for third parties that own royalties. But the first thing that we do, and we have a database, which I think we've spoken about with Lytham previously, we have a database that we believe is the largest proprietary gathering of information on third-party royalties all around the world. And what third-party means is we don't actually fund mining companies, we don't finance mining companies. We look for individuals, prospectors, various companies that own these rights to royalties, and that's what we buy around the world. So what we look for is we're always scanning the world and the globe for essentially really interesting developments on assets that we like. We then go into our database to see if a royalty exists on that project and who owns that. And then at that point in time, we're getting in touch with these various owners to see if they're willing to transact. And so we've accumulated a portfolio of 60 royalties that entitle us to a revenue percentage of these operations. We have 6 of those royalties are currently in production, and we expect that to grow to double digits as we exit 2023. So it's some of the most profound growth in the industry. And all of that's been achieved at what we would say are very good valuations on assets, where we're seeing a tremendous amount of current return on those assets, but also that long-term duration cash flow and long-term upside associated with that.
What are the characteristics of the acquisitions that you've made, or of the 60? What are the characteristics of those you are acquiring the royalty from?
Sure. The characteristics we look for, so where we find the deepest value for our shareholders, is typically assets that are anywhere from 3 months to 3 years out from production on a typical basis. And why that is our team is comprised of mining engineers and geologists on the front lines of our business. So you, the investor, don't have to be the mining engineer. You don't have to be the geologist. You don't have to have been looking at the sector for 30 years to have comfort that we're able to cherry pick the best assets that have the best royalties that we can acquire at the best valuations. And within that, what we look for is an asset that we believe is going to be in production within 3 months to 6 months to 24 months usually. And we're looking for assets that we believe, based on the data that we're seeing, are going to outperform generally market expectations, and then have a tremendous amount of additional upside that's likely not well understood at this stage. So for example, an open pit mine that has the potential to go underground, where you can take something that has a mine life of 10 to 15 years and it ends up being a 30 or 40-year life of mine. Those are the assets that we're looking for. That's what we're bringing into our portfolio. And so we've grown a really significant portfolio of royalties, 60. We are the second largest holder of hard rock mining royalties in Australia, behind the largest company in the industry, which is Franco-Nevada. And we have one of the most significant both asset coming online or into production profiles, alongside clearly exponentially growing revenues that coincide with assets coming into production.
And so when you make the acquisition of these royalties, is it typically just a landowner? Is it who typically are you acquiring the royalty from?
Well, it's an interesting question, because our database gives us basically a roadmap, or a global treasure map, if you will, all around the world to various esoteric holders of royalties. You wouldn't believe where royalties are found and the types of people that own royalties and the type of companies that own royalties. We found royalties that are held by telecommunications companies, hearing aid technology business, automotive parts businesses. We've actually bought royalties from those 3 different types of unique businesses. They didn't even know they had royalties most of the time. And that doesn't count the other groups that we've reached out to that we haven't been able to transact with, unfortunately. But those are 3 interesting case studies of various groups that we transacted with. And then on the other side of it, a lot of times it's the prospector. It's the individual that found this geological anomaly. They usually sold the asset or sold the mining rights to a big mining company. And the mining company gave them cash and a royalty. And the royalty was their perpetuity interest in the upside of these assets. And that's what we're buying. And so a lot of it's with prospectors. Some of it's with junior mining companies that used to own the assets and then sold those assets, and they retain the royalty interest. Right. And other unique examples are family offices in South America. We've had ranchers in South America as well that we've dealt with. So really, and ranchers actually in Nevada that we bought a royalty from. So we've transacted with this wide array of different royalty owners. What we solve for them is we're providing liquidity. So a lot of times with an asset that's anywhere from 3 months to 3 years out from production, there's a need for cash now, or it's almost an estate planning exercise where they want some diversification. And so they'll take our shares and look at it as diversifying across 60 royalties versus single asset exposure to one royalty. So that's the problem that we're solving. That's our client base on one side, and then our client base on the other side is obviously investors that are looking for the right kind of exposure. So that's kind of how Vox fits into this commodity ecosystem, if you will.
Right. You mentioned Australia here a moment ago. Talk about the geographic diversification, if you want to, or as it relates to, is it all Australia, North America? Where are the various assets held?
Yeah, Robert, you bring up a really interesting topic for us, and one that we like to talk about quite a bit, actually, is most of our royalties, almost 70%, are in Australia, with most of those being in Western Australia. And look, I'm in Denver, North American based, and for the most part, most of the investors that we're talking to with Lytham are also North American based. And what gets lost is the quality of Australia as a mining jurisdiction. It's the second largest producer of gold. It's the largest producer of iron ore on the planet. It has some of the best mining people. It has some of the best laws and consistency in application of law. It has some of the best infrastructure, and it has some of the world's best geology. And then that is where our IP is also the strongest. So when you're looking at a jurisdiction that appreciates mining, is really fertile for exploring, finding a new deposit, developing that deposit and bringing that deposit into production and then producing, we don't believe there's a better jurisdiction for that. The other thing that's great is that's where our IP is the strongest, but also when you look at gold in Australian dollar terms, it's been really at all-time highs for going on 4+ years now. What happens is there's a compounding effect to the royalty owner where we're not contributing the capital to achieve a lot of the growth that's happening there on the ground, but we get the benefit from it. And so with having sustained high metal prices, their equity markets for mining companies have been very buoyant. These operators have been able to really kind of push the pedal to the metal and develop these assets faster than we expected. With a higher sustained metal price, more ounces and more tons come into the mine plan, which are essentially dollars that we didn't expect to come in that are now hitting our income statement and have been really robust for us. So our cherry picking alongside our IP within the best mining jurisdiction in the world has really led us to a position where we're exceeding our very high expectations for the business and for our shareholders.
Got it. Talk a little bit about how you go about managing the technical mining risks, when you're evaluating new opportunities here.
Well, look, this industry is very, very difficult to understand. There are some mining specialist funds out there. They've taken positions in Vox. They like how we go about our business and how we find value for them as investors. But it's very, very difficult. And so our business, having mining engineers and geologists and multiple mining engineers and multiple geologists on the front lines alongside industry experts, has allowed us to really, I think, cherry pick the best assets, understand the risks, also understand the returns and the upside. And you see that playing out in our portfolio. So the investors can take some comfort that on the front lines of our business, not consultants. A lot of times consultants, they'll tell you what you want to hear. They're not equity holders in your business. Our management team owns 15%. And so when we're looking at investing in assets, we're looking at it as, that's our capital jointly with our investors and making sure that that's allocated and appropriated correctly, and the risks are taken into account appropriately. So we are allocating capital to these assets that we're buying very diligently, very thoroughly, with the right type of people that can really understand both the risks and the upsides.
Let's come back to the inflationary aspect to all this. Again, you're taking sort of right off the top line. You don't have to worry about many of the inflationary pressures that go into mining itself. Talk a little bit more about that, how it relates to the portfolio as a whole, and how investors might be able to benefit as a result of it.
Yeah, the reality is inflation is afflicting all of us as consumers. Most of the companies out there, most entities are deeply affected by the inflationary pressures that the globe is feeling right now. And so as a royalty company, we have this very unique business model where what a royalty means is you get a certain percentage. It's usually called a 1% NSR, net smelter returns royalty, or a 1 to 2% GRR, which would be a gross returns royalty. Anyway, they kind of mean essentially the same thing. You're taking top line. So when mining companies have to go expand their operations and put capital to do so, we're not on the hook for that. When mining companies have to pay their people, when they have to pay for input costs like diesel and infrastructure and steel, we don't pay for that. And so all of these cost pressures that are tearing away the margins of mining companies, those don't hit us because we're just taking the top line. And we cherry pick assets that can sustain, frankly, margin contraction where we don't feel that margin contraction. So they'll stay in production, they'll continue to generate revenue. The metal price, frankly, is much higher than we expect it to be. We're not a team of gold bugs. We're not out here proclaiming gold going to $3,000 or $5,000 or $10,000 an ounce. What we're looking for is really quality assets that have really quality royalties that we can buy at fantastic valuations and let that current revenue and that long-term upside and optionality play out within the portfolio. And it's really unique because those assets are inherently inflation protected. And there are not many assets on the planet right now or in the markets that are uniquely positioned to avoid the inflationary pressures like royalties and royalty companies like Vox.
Going back to the maybe the industry as a whole, there's been some, I think, significant discussion around consolidation. How do you see this evolving, and what role is Vox potentially able to play in that?
Yeah, look, I mean, we believe that we're tremendously undervalued. I was at a recent mining conference and I was asked, what would be your fire sale liquidation value? And we're trading there. The reality is, M&A is certainly happened in the space. It's happened certainly by volume more than it has in preceding years. I think we've had 3 or 4 different acquisitions of similar companies in our sector. So I do believe consolidation is coming. When and how that operates, no one knows. I think we are a very undervalued business. We certainly have our head down in terms of continuing to create the value within the company. And ultimately, we're working hard to see that reflected in the share price and the market valuation of the business, not just the inherent valuation of the business. So we'll see. Certainly, consolidation is a theme happening in our industry. I think that's a good thing generally. But in terms of where we fit into that, I would say we just view ourselves as deeply undervalued and in a position where we're going to be working hard to make sure that the fundamental value we have is reflected in the share price.
Recently, you announced sort of an inaugural quarterly dividend. Why now, and what does this maybe signal about upcoming revenue, cash flow expectations?
The dividend was really such an exciting announcement for us and for our shareholders. This business and why it was created and the genesis of it was to return the right type of returns to shareholders. And this is a very, very kind of big milestone along the way. It's certainly not the destination, but it is a big milestone to where we want to go, which is we believe that our revenue profile is growing significantly. We've gone from 1 producing asset to 6 producing assets. Expect that to be north of 10 producing assets as we exit 2023. Revenue growth coinciding alongside that producing asset growth. And so that obviously gave us confidence that, 1, we could put a meaningful dividend in place, which we believe this is. We believe that's sustainable, and we also believe that it can and will grow. So that is our position on it. It still leaves us with adequate room to continue financing the acquisition of new exciting royalties that are highly accretive. But ultimately, is signaling to investors that we are prepared and want to return capital to investors in the most tangible way possible, which is a dividend. And this is the first, we hope and expect of many dividends for many quarters to come.
You just sort of hit on, let's take sort of capital allocation as a whole, right? And you just talked about the ability to make further acquisitions. What is sort of the cadence or the expectation that you might have out there for further acquisitions for Vox going forward here?
The market is really volatile right now. So, I say that with some empathy for the companies that are experiencing and frankly, consumers as well that are experiencing difficulties because of the market volatility. The reality is our business is very strong. The fact that we're not exposed to the inflationary pressures really puts us in such a strong position as a business to continue realizing growth despite the macroeconomic backdrop. But, our ability to keep sourcing bilateral, unique opportunities where we're not in competitive waters. We have what I believe is our pipeline right now is more robust than it's ever been. My confidence in the business and the trajectory that it's on I'm more confident than I've ever been. And we've been in a really good position for the last 2.5 years since we've been public. We're pretty much quarter after quarter, we keep releasing record revenue. So we're really, really happy with where the business is. I'm equally excited with what our pipeline looks like. And then what we call the organic growth, the assets, the royalties that we already have in the business. 3 of our main revenue producing assets are currently undergoing expansions. So you're really confident that those are not only going to continue to deliver the revenue they're delivering now, but you're going to see that expand alongside new assets coming online that, we've already received notice from 1 that's in production now. So that will be revenue coming very shortly. And then 2 additional assets that are either in the final stages of construction or final stages of processing. So we're in a really good position to have that kind of comfort and confidence in the growing revenue dynamics of our business and profitability as well.
When you think about the most maybe misunderstood, undervalued sort of components of this business, what is it that investors just don't quite understand about it?
I think it's actually a bigger question than that, Robert. What I would say is misunderstood is the entire asset class. Most investors do not allocate, if any, enough to commodities within their portfolios. We've obviously seen the success of natural gas and oil over the last 18 months. The reality is metals will likely have their day in the sun. We don't need that to happen as a royalty company that's cherry picking the best assets. But a lot of investors are so gun shy, and that's why Vox was created, to invest in commodities because of the underperformance, because mining companies are such a capital intensive business Well, Vox is essentially a very capital light business. We have 7 full-time employees. It's very capable of scaling. And ultimately, when you look at some of the best performing companies in the industry, like Franco Nevada, that company has exceeded the returns of the NASDAQ Composite Index, the S&P, the physicals, the mining companies. And I believe it does that because we are really synthesizing the best aspects of owning a mining company without so many of the risks. And so I just don't think many investors have been exposed to royalty companies. And they certainly, most haven't been exposed to Vox. And if they have, in some cases, these royalty companies are mixing in equity interest, they're mixing in JVs, they're not a pure royalty company. And so it leaves investors a little bit confused as well. Vox is a pure royalty company. These assets are really profound in their capability to drive outsized value for shareholders. And most have not been exposed to it. And then most companies, for whatever the reason is, very few have stayed disciplined in terms of just buying royalties and staying disciplined on that mandate. And that's what Vox is. So it's really just understanding how profoundly productive royalties are and how unique they are, uniquely positioned they are, especially in an inflationary environment, but also from a lowering risk. We get all the upside without having to pay for it, but also we are in a position where we have 60 royalties, we have 6+ producing assets now, so we're diversified. And then if mining companies have problems, these royalties typically run with the land. So if one operator fails and another one comes in, our royalty usually doesn't, it essentially almost never gets stripped away. There are some very rare and unique circumstances that would happen. And so it's also a much safer form of investment from that perspective as well. Those are just some of the, I would say, the overarching both themes and I would say understandings that a lot of investors haven't been exposed to when it concerns royalties.
Got it. Maybe over the next, we'll use the next 6 months, 12 months. What are some of the other major catalysts that you think we can look for coming out of the company here?
Well, dividend was a big one. It was really nice. That benchmarks us at the higher end of our peers in terms of a yield. Again, we believe that dividend is sustainable. We believe that we positioned it to where it can grow. So we're excited about that. I think that continues to provide and be a catalyst for our investors. Also, one of the big, I would say, the questions I get a lot is, we're not the most liquid stock out there, and what are we doing about that? And I would say there's a big milestone that we're really excited for, and that is we have filed a 40F. We're in process to list on the NASDAQ, and we would expect, pending completion of the SEC review, we would expect to be on the NASDAQ within the next couple of weeks to couple months. And what we've seen is a lot of our peer royalty cos that have made that jump from the Toronto Stock Exchange or the Toronto Venture to the NASDAQ or the New York Stock Exchange, that their volume has gone up tremendously. And their share price has also has had an increase that coincided with that as well. So we're excited about that milestone. And then, as we touched on, we have another 3 gold assets coming online in Western Australia. We expect the expansions to be completed here in the near future over 3 of the assets that are already in production and contributing a lot of the revenue to Vox. And then we've got another few assets that we're expecting to come online over the next 18, 24 months as well. Also, complementing that will be other deals that we expect to bring in, other royalties that we expect to bring in at great valuations on great assets, and typically either cash flowing or near-term cash flowing. So the growth of the business, I think, is at an inflection point and at a profound place for investors to be looking at Vox as, even in a volatile marketplace, an interesting place to invest and maybe, ride out this storm that we're seeing across the equity markets and all assets of all kinds.
Great. Well, I always enjoy sort of the conversation here. Is there anything else that we sort of missed before we come to a close?
No, I think we covered a lot of ground. I think it's, if I had to leave investors with one point, it's that our business, despite the challenging circumstances of the market, is so strongly positioned both for continued growth and what I would say is, much less volatility. So for the investors looking for a place to invest in what is certainly a difficult investment climate, I think Vox is a really interesting company and well-positioned for investors to consider.
Sounds good. Kyle, we'll leave it there. Thank you very much for the time today. Greatly appreciate it. Again, I want to remind everyone, if you have not already signed up for a one-on-one meeting this week during the conference, send me an email, Bloom, B-L-U-M, @lythampartners.com. Visit the website, lythampartners.com/virtual. Click on that one-on-one meeting request button. We look to get you taken care of. We hope you all enjoy the conference. Kyle, thank you very much.
My pleasure. Thanks, Robert.